Gio, what have you got to teach us today?
If you have questions, I'll be more than glad to answer. I run a firm, Lifeblood Capital, that's fundamentally focused on building teams for medtech startups. We've been doing this for about 15 years. Just kicked off the firm this year, as Dwayne had mentioned, but was at a previous firm and did it for a long time. Built an international practice, fully focused on medical device startups. So I have my master's in regulatory affairs with a focal point in medical device, but we did it in life sciences. And my first 10 years was pretty much living on a plane, building a network for startups that was focused on actually achieving CE mark first. And then obviously over the past few years, the MDRs got kicked in place and changed the regulatory transition over to here in the FDA as at least a regulatory strategy first. So it was a good thing that I built a global practice, because now I'm helping a lot of international startups build their teams here in the United States for the first time. Build end-to-end, so work with a lot of venture capitalists who hire us to do CEOs for their portfolio companies and replace the founders if it's necessary, or independent board members. And then our dream goal / business model in a vacuum would be working directly with those CEOs, earlier stage companies who need a sounding board to actually build out and structure a team as they raise capital, as they hit milestones. So going through technical, clinical, manufacturing expansion, and then obviously if they make it that far, getting to a commercial level, and then helping them build multinational teams if they need. Where that comes in is they always need people, but they need the money first. So we've gone out and built a fairly robust process as well as network of investors, and ultimately help these startups ranging in early stage to growth stage, more so on the earlier stage, help them get in front of the investors and ultimately raise money. We're not investment bankers. We don't make any money off the intros. It's more of a value add and differentiator that we use for our practice.
You don't get a referral fee, nothing?
No, I don't feel like going to jail. It's against SEC. I'm not FINRA licensed. I'm not an investment banker. So
to make an introduction and someone says, if you introduce me to somebody and we end up signing a deal or getting money, I'll give you something. That's illegal.
Percentage fee? Yeah, that's illegal.
Compensation.
Well, it's a good thing I never closed one of those.
Yeah, I mean, I've done my jail time. I just don't feel like going back. So
that's a joke or not?
No, that's a joke.
Okay, well, we don't know. But
are you stereotyping me because I'm Italian?
I'm not even gonna. Don't, Andre, really? Don't wag a finger at me. I have the button that could disconnect you from this call, so just back off.
Another insult.
Okay, tell us, when did you become Mr. Medtech?
Mr. Medtech, that's like just a funny branding story, to be honest with you. I was in Leipzig, Germany at a conference in early January 2019. And, you know, I had this whole thing of, I like buying websites or URLs if no one's taken them before. I stopped doing it because it got too expensive, to be honest with you. I came up with too many names that were actually available and I started buying them all. But anyway, I loved my industry. I'm never leaving my industry. And we were at a conference in Leipzig, Germany in January, in Eastern Germany, which was super freaking cold. And there was a bunch of German physicians underneath the ground. They have Roman catacombs. And there was this, after the conference, there was this big party. And one of them just ended up calling me Mr. Medtech just as a joke. And it was a long friend of mine. And I was on a midnight flight back to Frankfurt. I had to do it at like 5 o'clock in the morning. And I had somewhat of a loopy mind going on. And I'm like, Mr. Medtech, I wonder if MrMedtech.com is available. And when I got to Frankfurt, I checked it out and it was. I immediately bought it. And I said, I have no idea what I'm going to do with this. So I'm just going to hold on to it and turn it into a hashtag for now on LinkedIn. And every post that I push out, it's just going to hashtag Mr. Medtech. And I did it religiously. And 6 months later, I was in San Francisco and I'm crossing a street and there's a guy on the other side of the street and he's eyeing me up and down. I've never met this guy in my life. I have no idea who he is. And he's looking at me intently. And as we're crossing the street, he's walking towards me and he goes, Mr. Medtech? And I'm like, oh my God, this thing is being branded. Like, let me have some fun with it. And that's when I just created an actual brand around it. I've since started to actually dial it back because I have to build a firm. I'm more keen on building my Lifeblood Capital firm right now. But that's the story of Mr. Medtech, and somehow it's stuck.
Very entertaining. A lesson in branding, ladies and gentlemen.
Yeah.
When I hear Lifeblood Capital, when I hear the word capital, I know in context you're talking about human capital, but I can't help but think about money first. Was that intentional?
It was intentional. It was intentional. It's a long-term growth strategy. And so obviously we are tying together the people and money aspect right now. We're already making seed stage investments off the balance sheet. So we are technically investors already, which is good. And we're building a track record to eventually become a institutional fund. It's probably going to take 3 to 5 years, but we'll get there.
Maybe to start the conversation in earnest, and I'm sure folks have questions for you. You've done now with Dwayne Mancini a couple of podcasts, and you talk about capital as in money. Maybe highlight for us one of the interviews you've had where you actually learned something that you did not know.
All 100 episodes, every single one of them.
Well, some more so than others. Maybe one that was really like, wow, that is completely new. I had no idea.
It's hard because selfishly, this podcast has been an incredible educational book for myself. I am lucky enough to have the ability to ask questions to people who will always be significantly smarter than me. I'll never have enough time to catch up to them. So I literally have learned something new on.
This is what my Friday is every week.
Yeah. If you're, gun to head type thing, one of the more insightful ones, and keep in mind the focal point of creating the podcast was for a particular audience, which has expanded outside of that. But I always created it for the medical device investor or entrepreneur who has never raised capital before and just needed a resource to hear from other entrepreneurs who have done it before. And also the inside scoop of the investors who actually deploy capital and how they think and what they do in terms of the mechanics of investing, so that they can actually understand how money flows within their industry. So my focal point has always been the medical device entrepreneur who's never done it before. It since has expanded on that, and it's been great feedback, which I've been super proud of. But there's one particular episode, Lewis Cannon, the founding managing partner and director of BioStar Capital, that's actually out of Michigan. He's a interventional cardiologist for 30 years. And 15 years ago, he actually founded a somewhat early stage venture capital firm dedicated to medical devices. He's a physician who turned into being an venture capitalist. And some of his insights on really what makes a medical device investable. When you have the physician's insight, and we talk about physician founders regularly, there's a lot of success stories that come from physician founders because ultimately they know really what the gaps are, how to get things paid for from reimbursement standpoints, or what the loophole is from the end user that's ultimately in the hospital setting or the healthcare system. So their intake or their perspective on building technology, and if they're an investor, really what makes sense to invest in is probably superior to any other profile in the industry. Obviously, there's exceptions, of course. But Louis' perspective on looking at early stage companies or even mid-stage companies, what are investable or what is an investable technology and why? And then what are just some of the more classical mistakes that entrepreneurs typically make in a vacuum, whether it's creating a technology that maybe doesn't have the market it's supposed to, or how they go about the actual process of raising capital, what story are they telling, et cetera. So his insights were mechanically inspirational, something that's like a how-to-do book, but also very intriguing to listen to.
Fair enough. Yes, I can monopolize this conversation with Gio. Who wants to chime in, ask something, an insight, either about human resources or capital? Richard?
Yeah, myself and Giovanni spoke once on the phone back in 2020.
How's it going?
In the height of COVID, I was walking around a very big garden in circles because I wouldn't go anywhere and I was living out the country in Ireland. Anyway, you were talking about startups not raising capital, right? So we've never raised capital. We've just internal funds, pocket money, whatever the case may be. We're 3.5 years in. We've never gone to the market looking for money. Does that have an impact on selling the company down the road? Is it better to have built up a really strong team with lots of debt and lots of capital investment, etc.? Or is it better just to hang on and go it alone?
If you can hang on and go it alone, Why wouldn't you? I think one of the main reasons why there's startup companies out there who look for external development. I mean, there's a lot of different ways you can take this conversation, by the way, and I've heard a lot of varying ways of you can doing it. I've heard of companies getting through pivotal clinical trials with funding from family offices before. And then they finally hit an inflection point where maybe the founders are truly technical or operational, but they have no clue of what it means to actually commercialize their technology. And so it takes a lot of money to go commercialize. And also it takes a different mindset and mentality. So maybe you go out to a venture capital firm that specializes in growth stage financing, who can write the big checks, but also has the resources and insights that offer value to help that company properly commercialize before they get an acquisition or go public, for example. So, when people look for money, early stages, it's typically because they need to keep the doors open and they obviously can't self-fund it for some odd reason, or they don't have the non-dilutive grant funding in hand right now, or they can't get it, whatever it may be. So you take money from lesser style of value adds, where maybe it's an angel group or an angel investor or a family office where, they're not professional investors, right? Maybe they're an angel investor and they have a full-time position, or they're retired, but they just don't really want to get overly involved, and they believe in you and they're going to give you a small amount, wish you all the best. I mean, if you have a question for them that they possibly can answer, maybe they'll do it, or they have a resource connection that they can find, but they're not going to do that 10 hours a week, 12 hours a week. A family office that's worth $1 billion or $100 million, and they invest industry agnostically, and maybe you have a heart failure technology that the father of the family passed away from, and they impactfully want to make an investment into heart failure. And keep in mind, if they write a $500,000 check or $1 million check and they're a $100 million family office, it's like if you have $100 and you lose $1, are you going under? Not really. But if you're at a cocktail party and you're at a family fund and you're around a bunch of rich people and you're like, yeah, I'm going to try to change heart failure, I just made a great impact investment. I mean, that's how family offices are. They're not going to add incredible in value. I mean, they could make some connections, but it's not their profession. When you start getting go ahead.
It's as much to do with the network side of it. Is it advisable to get in on a capital network side of things? Because I know a lot of people here, I know a lot of people in the industry, but on the big capital side, I wouldn't have a network for that.
Right.
So if my ultimate goal is next year after, whatever, to sell out, would it be advisable to try and get into a network where there might be medtech capital or IT capital wandering around?
So my first question would be you do have an exit strategy? I mean, do you have ambition? First and foremost, is your company in a position to possibly go public or be acquired? Is that even an option, or is it
be acquired? I wouldn't go down the public route.
Okay, so if it's acquirable, do you have an idea of what companies potentially could be your acquirers?
Well, that's the other side of it. We've a few suitors we would like to be interested in us, but getting them interested might be another argument.
So if you, for some reason, have a technology or a product that could fit within certain acquirers, I mean, if it doesn't sound like you need money to keep operationally functional. If that's the case.
No, we're doing well. We're lucky. We're not in debt. Not in debt, haven't raised capital, have managed to keep the head above water for the last 3.5 years and still growing.
So you don't need venture capital, or you don't need investors in order to get acquired. Companies acquire other companies because they want the product, independent of how they got to the end stage. I mean, obviously there's due diligence involved, but if you're able to keep the doors open and you don't need external money, and you're building a solid business that has a value to potential acquirers, I mean, just go out and build the relationships with the acquirers and keep them updated on your progress and traction, and also leverage your relationships with them and say, don't tell them or ask them like, when do you want to buy us, or what do you want to buy us for, et cetera. I mean, I recommend this to all my startups who are reaching out to VCs. Never ask a VC for money. Never tell them I'm raising $10 million, I'm raising $2 million, I'm raising $15 million. Tell them you want to share their story and keep them up to date, and also learn how we could potentially partner with their fund. because it's like the first time you meet somebody and they ask you for money. Do you want to give them money? No. But if you build a relationship and you're like, wow, what they're doing is pretty interesting. Oh, they're growing again. Oh, they're getting updated again. I mean, that's when the value is created. So if you don't need money, don't take money. And if you have potential suitors, go build relationships with the suitors, and along the way, keep them updated, but also ask what would be of value to them to incorporate into your business to make your business more valuable for them to potentially acquire you.
Sound advice. Giovanni, thank you very much.
I've taken myself off camera and audio because my son bought me a knish, and you don't have to watch me eat that. So I'll continue to coordinate a bit, and I have like late checkout stuff. But Elizabeth, you shared something in chat, and then Paul, you had something. Elizabeth Cross-Nickel.
Hey, yeah, thanks very much, Joe. One of the things I put in chat was, if you are delayed by deciding that you are going to stay non-diluted. So sometimes if you're not actually bringing in extra capital, it takes you a little bit longer to actually get to market. And there are some advantages and disadvantages of staying without taking in capital, but you just want to weigh that. Would there ever be a chance that you would actually miss your market entry time point because you were more inclined to be reserved on your ownership, and therefore you might not have the value in the long run because you actually missed the timing?
The direct answer is yes, that's always a possibility. Yeah, I mean, market timing is everything, and sometimes a company's too early and they've done all the right things, but they're too early, and other times they've missed the window. I've seen it plenty of times on both sides of the equation. It's, I would say, having a strong pulse on who your direct competitors are, if there are any. And then also, I mean, once again, do you have an exit strategy of wanting to be acquired? Is that an end goal, or yes? Is that an end goal?
It can be an end goal. I think that people have to decide whether or not they're actually what sometimes people use the term, I think, a lifestyle company, where they actually are staying with this company over the long run, going to run it, be an operator, or their goal is to actually get at least the technology out there so that others can use it and let someone else do the business component of it, is take to market, which actually goes back to your earlier comment.
Yeah. If your strategy is ultimately a potential exit, and I mean, regurgitating sage advice from a lot more people outside myself is, I mean, you never build a business for acquisition because you can't time an acquisition. You have to build a business which ultimately creates value, of which if someone sees the value, they're going to take you out. Along the way, you should be cognizantly aware of who your potential suitors are, or potential acquirers are. And once again, building those relationships, that's key, that's vital. But knowing who your competitors are too. And there's a lot of market work that you have to understand. I mean, if you're living in a vacuum and you're not paying attention to acquirers, you don't know who your suitors are, and you're just worried about dilution and not taking out outside money, then you don't really even know where you are in the market. So I hope I'm trying to answer your question the best, but I'm just trying to understand if you're more worried about dilution, and that's why you're not trying to take out external money, which could cause you to delay commercialization, which could possibly cause you to not make the market entry at the right time, or if it's just in general, you're worried about missing the mark just because of market dynamics. That was a question.
A question for me or for Richard?
For you.
Yeah. No, for us, we're actually, so I have a startup, and we're not worried about dilution at this moment because we're at the MVP stage. But I do actually do some advice to other startups who come and they say, oh, I've been spending 2 years trying to get non-diluted funding, and every time I get to the almost ready to fund level at NIH or NSF, but I don't actually get the money. So now I'm going to spend more time working on the next grant proposal. And we say to them sometimes, maybe you're actually better to take a little bit of money of somebody else, so that instead of spending your time grant writing, you can actually spend your time on the business component. So I was curious as to your thoughts on that kind of balance.
Yeah. So if you need external money, I mean, there's a lot of pros that come with non-dilutive capital from the NIH, NSF, et cetera. They often come with tethers because in order to get that money, you're signing up for executing on research or certain milestones that money is supposed to be used for. So I've heard of other companies who've taken on non-dilutive grant money and they feel constricted, for example, especially if they're married to a certain project for that money's for, and dynamics in the market change or their business plan changes and they don't have the freedom to adapt and utilize that money for that. Other than that, non-dilutive money is very powerful. It's often a very positive signal for investors because if investors see that they're getting non-dilutive capital, it's only a benefit to them, also a validation of the potential technology and company. The downside is that it takes a long time. So if you are in a position where you are needing external money, then you ultimately need more than one option in terms of getting that money. If you're doing things in parallel, like I'm working with a startup company right now that they're in a program where they can get potential non-dilutive capital from the NIH up to $1.5 million contingent upon if they raise $1.5 million from an external company or an external investor, which then realistically they're calling their seed round a $3 million seed round, but half of it's non-dilutive and half of it's dilutive. The story there is it's great for investors because realistically, if you're investing in as part of that 1.5, you're investing into a company that upon completion of that 1.5 triggers $3 million of raised capital for that company and you own a piece of that. So that's powerful. Hopefully I'm answering your question, but I think in parallel, raising external money, if you need external money, and also that's a whole different conversation of what does that money really need to look like? Is it VC money? Is it angel money? Is it family office money? Are you looking for advice, counsel, value added beyond a check? Or do you got this right now and you just really need capital your way because it's early stage and you want to go raise angel money?
It's interesting. In other industries, less likely in the health and life sciences, you can actually do revenue generation loans, which are backed on your revenue. So as you continue to raise revenue, the loan is paid back. And so that's a different way. But we're all in the industry where we're often not raising revenue at the early stages here. And so that kind of a sage capital revenue redemption sort of strategy is not always feasible.
Yeah.
Thanks.
Yeah, of course.
Paul?
Thanks, Joe. Giovanni, first a comment, actually for the group, first a comment and then a question for Giovanni. So I think the conversations are exactly right. I don't think, should you take money, should you not take money? It's not a simple answer. And the approach is also, right, it's an art form, in my opinion, anchored in very personal decision, how much money to raise and whether you should or not. The downside of not raising capital, and I'm saying too much, and I in my mind, I'm thinking about a company that made spectral photometers and was doing deals with, large pharma that was on the chemical side of doing chemical research on the side of the house. NIH, every major university in the world, we were selling into 27 countries. I took over as the interim CEO, and I was recommending that they position the company for sale. And the end of the story was they didn't. They wanted a lifestyle business in Athens, Georgia. They were very happy that the owner lived on a 70-acre farm with his horses. Downside to that was they didn't, because when you look for capital or think of a merger, the quality of business process increases. You start running your business according to industry standards. That itself produces value, right? And when there is no external pressure to create SOPs and standards of care and how you manage your business, you tend to really just do yourself a lot of disservice. If I could go to market with an offer, because I spend a lot of time on the PE side of the house, buy companies, merge them, stuff like that. And I've lost so many deals because the people don't have their head in the right place. I would say never build a lifestyle business unless you just plan to die and wrap it up, because just wasting time and money. That's my humble opinion. But because even if you want it for yourself and your family, right? If you want to create an asset for your family, when you don't think of an external stimulus, I deal with turning businesses around, and man, it's so difficult to get people to do the right thing, right? Just create value for yourself. So yes, it's an art form. It's not a simple answer. Everybody's touched on points, but I just want to say that if you have a chance to advise people, I'd say take some money, and somebody did say that, Be very strategic. It's never a simple answer. Like sometimes people take too much money from friends and family. They don't want to get the big money. Now the cap table is totally upside down. It's unhealthy, right? And then you get a serious investor and they're like, shit, I got to talk to all these idiots. It's like, and you shot yourself in the foot. So yeah, it's an art form. It's not a simple answer, but I say lean towards, collaborating. Because, I have a personal thing in life. I say it takes a village. Just open it up, increase the standards, right? So anyway, so that's that comment, and happy to explore that further. But Giovanni, love everything you're saying. I love your strategic Trojan horse approach of getting people in and then investing in capital, and really that I love the step one, step two strategy. You're here chatting with us. Is anything specific we can help you with as a group?
Thanks for the ask. And by the way, I wanted just to touch on your comment on cap table management, and if you take too much from friends and family as an angels. And I mean, once again, cap table management is a real thing, and I strongly advise people to invest in, whether it's books, podcasts, audio, whatever it may be, to learn about the downsides of a bad cap table. Two things real quick, one anecdotal story and then one comment, and actually let me put that in reverse order. Cap tables can scare off investors, even if it's the right investor with the right technology at the right time. And if the cap table is all over the place, it literally will scare off investors, because they know the challenge that it will take for getting decisions across the board, for getting a consensus, if you will, on certain things that need to happen. And it can get really, really nasty. And even if the technology is ripe with the right market and the right valuation, it's not worth their headache. And I've seen investors pass just because of that. Anecdotal story is, I have a really good friend who happens to be a CEO of a medtech startup who did that, in fact. However, he's made it his life mission to basically do cap table management, because he knows that he messed up earlier on, and is now making it a second full-time job just to make sure that the business continues. And so when you have 140 angels on your cap table before you even start going out and raising venture capital, for example, which only ends up being one line item, or if you take a syndicate of 3 to 5 VCs, only adds 3 to 5 more. Now you have 143 or 145, and you're at Series A or maybe Series B. I mean, good luck talking to Series C investors, even if you get that far. But this guy, like literally, to make a semi-simple decision or even an update, spends his entire Saturday and Sunday writing emails to all 143 investors, and then has to wait for their responses to see if he can get the majority consensus that would then approve that particular, and it could be something small. You're talking about sidelining operational decisions because you have a lot of people to report to, and because of the operating agreement, you have a lot of yeses to come back. And then if you don't have consensus, you literally have to chase down your investors to get an answer, because no answer doesn't count. So cap table management is real. And I would strongly recommend everyone investing in learning that if you don't know. Honestly, and then in terms of, thank you for the offer, but Joe asked me to jump on here. I haven't seen Joe in a long time. I was fortunate enough to actually meet Joe in person a long time ago in Seattle. And he asked me to jump on and talk and share. And I love doing this. So just being here is enough, to be honest. Thank you.
That's very kind.
So
Alyssa?
Joe, sorry.
Yeah, you're done, Paul. Alyssa?
So actually, I was speaking with Giovanni about this a while ago. I want to make sure to point out there for new people that are starting new startups that haven't done this process before. Your company is considerably more valuable when you're producing revenue, even if it's just a little bit of revenue. It allows the opportunity to work through kinks and ensure that you have a place in the market. And it's the time value of money theory. So that's where the real balance comes into play. How quickly do you need to get to market to become competitive? And if like when they had a whole bunch of frozen yogurt stores, I don't know if it was like you guys, but this area had like a frozen yogurt store on every single block about 5 years ago, it seemed like. And they just, the supply was not equal to the demand. And a lot of them failed because they didn't recognize how many people were coming to market at that point. So know your audience, know what is coming to market, which is really hard to do. And then states do have you don't even have to go through the NIH grant programs. There are states, there's a big, I think Biden signed a large, he signed, I don't know if it was a bill, but he signed something that gave the states grant funding for innovation. So they do have those match programs available through your state as well. For mine, it's Missouri Technology Corporation. And then lastly, when you do have capital, you don't have to use it. It can sit in a bank account and accrue interest, and you can pay back your investors with that interest as well. There's plenty of options. We don't have to limit ourselves to just to one theory. This is a market that is ever evolving, ever changing, and our minds need to think like that. There's no rule for a one rule theory. And that's it. That's off of my soapbox.
Andy?
Yeah, thanks. So we are, I guess, in a similar situation to Richard, where we bootstrapped our business for a number of years, actually, and we actually have revenue, but we're developing a whole new product line that's going to require additional capital, and we do anticipate receiving an NIH grant shortly, but we're probably going to need additional capital for commercialization and so forth. And we're in the wound and ostomy care space, so we're kind of all about poop, not very glamorous. And so in looking out there at investors, potential investors, it's just kind of an interesting space. But there are some strategics out there that we've had some conversations with, and I just ask, could you speak to the pros and cons of taking potential investment from a strategic? And also, it'd be interesting to, if you could repeat the advice you mentioned about not asking investors for money. I thought that was very interesting.
Remind me on that second one, because I'll talk to you about the strategic thing, and I want to make sure I answer all of the questions. So
sure.
The pros and cons of taking strategic money, covered it several times on the podcast. I'm glad to send you those episodes too, because much more brilliant people will elaborate on it. Sure. Just quickly, the cons are timing. So very similar to non-dilutive grants, they're very time-consuming processes. So you have to think about timelines and motivation. When there's an institutional investor, timing's a little bit more interesting. You know, they have a 10-year horizon that they have to return back. They're constantly sourcing deals. I mean, the one thing that I always have to kind of recenter myself with when it comes to institutional investors are, yes, we're in the medical device industry. Yes, they're investing in medical device technologies and this concept of growing the medical device industry so that we can ultimately help patients and create a better world with better healthcare. But professional investors are in it for one thing first and foremost, and that's a return. And you have, as a medical device entrepreneur, have to realize and create an opportunity that makes sense to an investor where, simply put, why are they giving you $1 when they can put it in a direct-to-consumer play, or they can put it in the stock market, or they can put it in a bond? Or, I mean, it's that simple. Like, why?
Or they could buy gasoline or feed their family.
Exactly. Why give it to you first? So going back to the strategic aspect, strategics are typically multi-billion-dollar business that are already off and running. They don't really have timelines, maybe if they're beholden to certain market sensitivities that they want to get in new products so that they can capitalize on the market inertia. However, they don't need to take 1 or 2 or maybe even 3 months to run a due diligence process, because they're not under any timelines. You're not investing or buying you is not going to tank their multi-billion-dollar business. So the downside of taking corporate capital is somewhat similar to the non-dilutive aspect, is that it just takes time. I mean, when you get involved in business development teams at Boston Scientific or Medtronic or Smith & Nephew or whatever it may be, if you think that you reach out and you make a connection on a Monday and you're going to convince them otherwise, and you're going to ultimately get an investment from a corporate VC, corporate strategic, within 3 months, you're just setting yourself up for failed expectations and disappointment. If you know that you're going out to raise money and you're allotting yourself, and more importantly, your psychological expectations that you're going to give yourself a year to build relationships, tell stories, get feedback, refine your deck, give updates, and then show the value as to why someone's going to invest 3 to 4 months of due diligence after taking 6 to 9 months of building that relationship and giving that valuable updates with them. That's how corporate will invest in you. That's how you'll ultimately get Medtronic to take your round, lead your round, or even potentially put in a strategic agreement where upon hitting certain milestones with your company, they'll take you out for 250 million, right? But that takes time. That's the downside. The upside is you have a company that is interested in investing in you, potentially acquiring you, and they have seemingly unlimited resources at their fingertips. Are you going to go into a distribution agreement because you're already generating revenue and they already have the sales teams, which you don't have to hire, pay, and assemble? Or if you're earlier stage or even developing additional product lines, do they have a quality system that they can just dump into your company? Do they have regulatory specialists and a division that can give you better insight as to how to run your regulatory strategy or run your clinicals? I mean, the resources are seemingly endless when it comes supply chains. So when it comes to working with a corporate strategic, it's about the resources they already have underneath their roof that you have access to because you're now part of their family. The other thing about corporate strategics, which you can find it if you know that you have to look for it, more often than not, strategics won't lead a round. You can prove me wrong. I've been proven wrong on that before. They do lead rounds. It's just typical that they don't. They join in as syndicates if they don't put together a corporate strategic strategy of, once again, acquiring you after certain milestones. The reason being is because they typically won't buy more than 20% of your company. If they take more than 20% of your company, it becomes a gap accounting situation and your losses on your balance sheet become theirs, and it just becomes an absolute nightmare. So if it's anything, they'll invest to try to take up anything less than 20% of your company as an investment, because then they don't have to report it on their balance sheet or their profit and loss. That's the pros and cons, high level.
Excellent. Yeah, thank you. And then just the other question was around not asking for money when you go ask for money.
Yeah, so it plays into kind of what I just talked about with the 9 to 10 month or 12 month thing. Like, give yourself time to go out and raise, especially if it's your first time. Like, if you don't have a network of VCs, and if you haven't already been talking to investors and they don't know your story, I mean, if it happens earlier, excellent. But you got to give yourself a year, plan for a year. If it gets done in 6 months, I mean, put something out on LinkedIn and we'll all like it. But if you have to establish a relationship, and what I mean by, very rarely does the cold call or cold email work where you have the most amazing deck, you've never met this person, you have a compelling story, and then you sign off with, and we're raising a $10 million Series B. By the way, we want to close in 2 months. Well, okay. The company has no relationship with you. They don't know who you are. They don't understand what the entrepreneurs are doing, all that kind of stuff. If you go out and you put together a very similar message, to be honest with you, but you saying, hi, Catalyst Health Ventures, I would like to get on your radar as we're building a product in atrial fibrillation. And I know that you guys take an interest in cardiovascular early stage companies because that's what we are. And I see that from your portfolio. I would love to tell you our story and let you know the traction that we've achieved to date. Also, what our future milestones are over the next 3 to 6 to 9 months, and keep you aware of those. And also, if you're open to it, would love to send you a quarterly update. It's completely non-threatening. You're going to make a friend. It makes sense because you're connecting dots. It allows for someone to take on a conversation with an investor, which then you're simply like, you're not trying to sell them on leading your $10 million Series B on your first phone call. It's kind of like dating, as cliche as that analogy is that everyone uses in our industry, and I'm sure in other industries, it's the truth. Like, you don't talk about marriage on the first date. Why are you going to talk about closing them on 10 million on your first call? Let them know what your story is, your value proposition are, who's your clinical scientific advisory board, who's on your board, who have you gotten to wake up every day and help build your technology, what traction have you had, what amount of money and investors have invested in to date, are you generating revenue? Let them know the story, and then ultimately say, hey, per your portfolio and what you guys believe in and your thesis, what would you need to see from us to allow us to be ready to have more serious conversations if we can be part of your portfolio? You're literally asking them, what do we need to do so that you'll invest in us in a softer way? And then you're building that relationship over time. And then when it comes time to being like, hey, we're honestly raising our Series B right now, glad we kept you up to date. And I have a couple potential interests at this point. Want to know if it's time to jump in. I mean, that's when you go for the jugular, but it's got to come after like 6 to 12 months, maybe even 2 years. But that's why they say entrepreneurs are always raising money, always, because they're just always building relationships.
A couple of things. First, administratively, we're at the top of the hour soon, but we continue as long as we continue, as long as Gio has time and you guys stay on. For those of you who drop off at the top of the hour, we are recording and I do post them and you can watch later. Second is, Gio, you have built a name for yourself, a brand for yourself, and we don't talk often enough. I see you getting, in my view, bigger and bigger, and it's like your image is, to me, a very important person to know in the industry, and you're so delightfully easy to listen to and learn from and approachable, and I think that's great. So thanks.
Thank you, Joe. It's hard to live up to that, but thank you for the ego boost.
Sure. And then I have at least 3 more things in queue. Michelle, I think you were first. You want to come back on camera?
Sure. Hi. It was good to see you again.
It was great seeing you in Houston not all that long ago.
Yeah, that was fun. You guys did a great event.
Thank you.
I'm pretty heavily involved in the angel community. And I see, I think that if you're going to be a life science investor, whether you know regulatory or not, you kind of have an obligation to understand basic regulatory principles and kind of stay at least in the know about things, maybe not the details, but I commonly see people like either making a pitch that says they're going to go to Europe first because it's easier, or B, an investor who's, the dust is blowing off his skin because he's that 1 foot out of the grave, is saying, 20 years ago, I had this great exit because we went to Europe first, and why aren't you considering Europe? Like, what are some of those top questions on both sides of the fence? What are some of the top questions you would say that the company needs to be aware of, and the top questions the investor should ask to be up to date and to kind of do their own vetting before they bring in a rate? What are some of the questions that would raise a red flag from a regulatory quality perspective to you?
From an angel perspective, right? We're talking that early stage.
Yeah.
Yeah. My biggest fear as an angel investor, especially if you don't know really what the regulated industry entails, is those startup companies, and you touch base on this and we touch base on this on your panel in Houston, is what is your classification? Are you a class 2 or are you a class 3? Have you done your QSub meeting yet? Have you done your 513G? I mean, when there's a first-time entrepreneur who may be a engineer or a scientist or a VP of sales who's converting over to wanting to run a company, or a physician, and they have this idea, and they can't tell you if it's a 510K, de novo, or a PMA. I mean, likely on this call, there's no one that knows, at least in depthly, as much as you on what that means and those differentiators. So when you think about, am I giving an angel investment and my personal money, I'm going to write you a check for 10 grand, 50 grand, whatever it may be, but it's coming out of my pocket, and the entrepreneur can't tell me if they're going to have to run a clinical trial because they're a PMA, or they don't know if it's a 510K and is there any clinical work involved, or are they a de novo, or do they even have a semblance of a predicate device? So I run into entrepreneurs regularly that they can't tell you, even if it's an assumption, what classification it is. And as an entrepreneur, am I signing up for a 3 or 5 year potential build out with a potential exit for a 510K? Or did I just give a $15,000 or $20,000 personal check that ultimately ends up becoming a PMA because they had no clue? And I didn't really either. And I just signed up for a 10-year or 7.5 year venture, which has a very high likelihood of failure because it requires a 200 patient clinical trial that these people don't know how to raise the money to ultimately raise the 40 million in Series B to get that. And that's already 4 years away. I mean, that's a big red flag. So know what you're getting involved in, right? Like which classification, that would be like my first thing. If they do know what classification that they are, one of the major things is moonlighting. Is this someone who's giving 100% of, is this full-time? Are you also an engineer at Medtronic, but you're a co-founder on the side and building this on Saturdays and Sundays? What are the co-founders?
Yeah, what is your opinion about practicing physicians?
I wouldn't do it. I mean, that with my personal money, obviously. I mean, if you ask me if I'm investing into a practicing physician idea, and I don't know the rest of the story, right? Is it a physician who has a great idea, who through personal financing has garnered a few consultants that got the idea far enough, and there's literally no one else on the management team or co-founder team, and it's just a one man or woman show? Nope, not for me. There's just too much that is at stake. Also, how are you going to build? And I take calls regularly from physicians who have ideas. And the first question is, are you practicing? And who's also leading this on a 24-hour basis? If the answer is no one, ideas are high volume. And we all laugh about throughout life of, oh my God, I wish I would have thought of that. Well, a lot of people thought of it. It's just who acted on it. I mean, there's a lot of medical technology that probably could be innovated, but there's families that need to be paid for. There's full-time jobs that people have. And if you're not going to take the leap of faith and build a team or do it full-time, I mean, what's your money going to? It's too easy for someone to quit, and startups fall apart all the time.
In the interest of time, Kevin.
I just had a comment back, going back to Andy there, looking at some of the options, I guess, depending on, how much you need to raise. There are also options that are kind of public-private partnerships. And, I've been working with trying to get money from J Labs, which is working with BARDA. So you kind of get the benefit of having a strategic partner, although like you're not tied to them. If you find somebody else to commercialize, they're totally okay, but it gives you kind of a backstop of that large strategic to give you resources as well as the non-dilutive government money. So that was my comment for Andy, and I kind of wanted Giovanni's take on adding advisors early on in exchange for equity.
Yes. So the answer is yes. I mean, obviously you have to vet them out and make sure that they're seriously adding value. I think, in full transparency, and the day of LinkedIn and everyone has 15 things going on their LinkedIn profile all at the same time. There's a lot of people who are advisors or board of directors, and there's just not enough time in the day to actually make that realistic for someone to be on 13 different boards, right? So my counsel on that one is have a relationship with who you really are going to bring on people with advisors, and make sure they're really adding value. If you're bringing them on because you want a marquee name on your slide deck when you're going to show investors, I mean, another point, that podcast episode that I alluded to earlier from Louis Cannon, he actually says the exact same thing. I mean, investors invest and they're smart. I mean, they can see through the BS, to be honest with you. And if you're going to put together a slide deck and have, the CEO of Boston Scientific that you met one time, and he just simply agreed to be on your slide deck, and everyone knows that that person is not readily available for you to ask questions to, right? You have to build an advisory board or a board of directors that means something. If you're going to bring an independent board member on your board, it's more than just showing up to the 4 board meetings a year every quarter. They have to add value. Same thing with advisors. In terms of equity, if that's your specific question, you always have to be cautious with your equity. I mean, yes, you have to incentivize human beings, and no one's going to work for free. I mean, and that's called a friend, if they do. And also the sustainability of that is probably very short term, even if you have a good relationship with them. But if you are going to give equity, keep in mind that it has to fall within your ASOP pool or a dedicated pool that is not going to throw off investors, because it's the same thing. I mean, if you find, I'm making it up, a CEO who has transacted 3 companies and they have this breadth of amazing knowledge and advice that they can share with you, and somehow you caught him in the right time in his or her life that they would love to be on an advisor for you, and you're just like, wow, this is like better than having a CEO run my company and I'm the CEO. Don't give them 3% or 5% of your company or 2% of your company. The investors are going to look at your cap table again of who owns what, and they're going to be like, okay, well, once again, great product, but this whole thing is just messed up, and it's going to be, the whole cap table needs to be redone, and somebody's going to get super pissed off, and it's just going to get super messy. So you have to find a fine balance of bringing on an advisory board that is certainly adding real value, not just a marquee name on the slide deck or their LinkedIn profile, and then incentivize them, but incentivize them that it really makes sense. Like I I put an independent board member onto a semi-early stage commercialization company. The whole company is 15 people. They're generating about $300,000 in revenue their annual first year. They will obviously be scaling up, but they wanted an independent board member to have an odd number in order to have a tiebreaker for decision making. Very, very experienced current CEO joining an independent board seat for this company. Got 5% equity over a 3-year vesting schedule. I'm sorry, 0.5%, half a percent over 3 years. I mean, that's normal. That's incentives, but also paying for value. Giving away points of your company is detrimental.
So, Brett, are you still
Thank
on
you.
the call? Maybe he had to hang up. No, he's here. So, Brett, you had a comment or question?
Oh, no, yeah, I have a quick question. Like, as a first-time founder who is trying to raise something like seed or angel, what are your suggestions and questions? Like, what are the things he or she should do?
You're raising a seed round of financing, and you know that you're targeting angels.
Yes, just a very small amount, just to start with and continue to go from there.
Where do you live?
I live in Dallas, Fort Worth area.
So first and foremost, get involved in Capital Factory. Brian Chambers, CEO of Capital Factory, is arguably the largest check writer in the entire state of Texas. And that's what they do, is write small checks in high volumes. So get involved in Capital Factory. They are aggressively moving into life sciences and medical devices. He fortunately was at our event a couple of weeks ago in Houston, and it's a wonderful human being. The entity of Capital Factory is very important. There was a lot of medical device startup companies there that started off with investments from the state of Texas, which is what Capital Factory is promoting. So that's an option. If you know that you're going after early stage, small amounts of money, angels, you're 100% correct in doing that. Sometimes people don't even know that much, and they're trying to go after VCs for their first money in. Huge waste of time. If I was dealing with this with another entrepreneur yesterday. Save yourself the headache and do a convertible note or safe round on your seed round. Try to do a priced equity round on your first round of financing, external financing. You're going to get into tug of war matches of valuations. Investors ultimately would prefer or love a price round because they know what they're buying, but it's very, very common practice for angels to get involved in convertible notes and safes. Safes are more easy and entrepreneur friendly, because convertible notes are ultimately debt. Very rarely ends up converting to that, where it would be really messy if that did happen. But safes are entrepreneurial friendly. I think you can download the form of a safe note from Y Combinator's website. Very, very straightforward. And keep it regional. You can go nationwide with very hyper-specific angel groups. In the Bay Area, there's Life Science Angels. You have Mass Angels up in Massachusetts. You have MABA in Baltimore. You have the Houston Angel Network in Houston, for example, that's very medical device heavy. And then the Gopher Angels up in Minnesota, a very prominent medical device angel group. So find those angel groups. The groups are a little bit more identifiable on.
So is it I have to little bit narrow down into who focus on software, because I'm trying to keep the focus product around the software categories. So is it I have to go to a very specific group, or do the
if you're raising capital for, I'm assuming, software or a SaaS-based model, once again, then I would, if you wanted a straight advice, I would just pull up a safe note and go raise from angels, and keep it there. Start with local angel groups, keep the money as local as possible. That's typically how angels work. If you then have a very strong value proposition, start looking coast to coast at hyper-specific angel groups. But not to be generic, but if you're having a software with a life science or medical overlay, a Google search of software angel groups, you'll be able to pull a string in an hour and a half and find enough groups to reach out to.
Thank you, Giovanni.
Mm-hmm.
I need to wrap soon, simply because I will be kicked out of this hotel room. Elizabeth writes, do you have a cap table management software or a consulting group that you recommend?
Carta. That's the easiest question in the world. CARTA.com. Go to Carta, and it's arguably the largest cap table management company out there. It's used by thousands, if not millions. CART, I'll put it in the.
Yep. I actually have a private investment somewhere, and that's how I get my information.
There you go.
And Mark, you're writing something about SAFE, S-A-F-E, all caps. I'm not as familiar.
Yeah, I mean, SAFE is just a structure that that we were talking about as a way to value the round on a future event when you'll have more information. But Y Combinator's revised it, and there's a big difference between the old and the new version. So just be aware of it. One's much more investor friendly. The new one.
I mean, at the end of the day, I think it was a guidance document, to be honest with you, for someone who wanted to do it simply the one that was originally on the Y Combinator one. But the best rule of thumb whenever raising capital and getting to some sort of signed agreement is have a lawyer for both sides. And that lawyer will be able to best support the decisions or interests of both parties to come to a conclusion.
Gio, this was great. Thank you. I hope you'll join us on weeks even when you're not our featured guest. We do this every Friday. Next week, Chris Kelly is going to talk about how to avoid surprise defects and reveal the blind spots in your medical device software. The following week, Bijan is going to talk about risk and how to assess it. And on the 11th, Alberto, my friend, will tell us about his company, and we'll do one of those concentrated consulting things where we can tell him what we're hearing, what we like, have you considered, do you know, that kind of stuff. It's one of my favorite types of weekly events. Gio, we should talk more. Thanks everyone for joining. And
thank you for having me, Joe. Good to see you, man.
Ciao, Giovanni.
Travels. Ciao, ciao.
Bye now.
Thank you.